Happy New Year. I'm going to be talking about the outlook, but also focusing on the issue of what usually happens to markets as interest rates rise. And let's look first as to where the economy has got to. This is up to the third quarter. We're just starting to get the fourth quarter data come through now, but not for very much so far. So the US is well ahead of pre-COVID. The UK is still behind and likely still behind in Q4, although it might have got there on the monthly numbers in December. The Eurozone just about at where it started, and Japan's still somewhat behind. So if we go forward to the outlook for 2022, and I'm going to be a little bit on the one hand, on the other hand here, but we've got some strong drivers, but we've also got some strong headwinds as we go into this year. So the drivers, the things which should be giving us decent growth. Number one, we've got pretty strong business confidence. And I'm thinking certainly the US, UK, Europe. If you look at the PMIs, the Purchasing Managers' Indices, if you look at the investment intentions, pretty strong business confidence generally, with the exception, obviously, of those companies that are still very much affected by COVID restrictions. We've got low inventories in goods industries, which means that they'll be trying to rebuild them this year, and that should help to give us growth. We've got rising employment, the job status being pretty good out of the US, UK, elsewhere. We've also got very strong asset prices, and I'll show you a chart on that in a moment. It's quite extraordinary how much stocks have gone up, but also house prices, and very different from the last economic cycle. And finally, we've got those accumulated savings. People couldn't spend, and also there was extra income provided by governments, and that, again, can be spent. And I'll show a chart on that as well in a moment. But there are some headwinds as well, and probably the biggest is the inflation that we're all talking about. If you've got inflation running at 6, 7, 8%, and wages rising at 4%, then real incomes are affected. People have less money in real terms to spend. So that's probably the biggest potential headwind. We've also got less fiscal largesse coming through at the moment. That's kind of wound down now. The extra unemployment benefits in the US, the extra checks the US was sending out, the furlough schemes in Europe, all those are winding down. We've got supply chain constraints, and they're still there, and potentially they could get worse with China's zero COVID policy, meaning they may have to shut down large areas, ports, factories, etc. And those supply chain constraints mean that you simply can't produce, so that affects GDP directly. Even though in the long run that is still supportive of growth, because presumably those things will get produced later when the supply chain constraints have eased. And finally, you've got rising interest rates. I don't think that's going to impact very much this year, at least to start with, but it will begin to, especially if rates continue to rise into 2023. So where's this going to come out? We've got headwinds and we've got some strong drivers. Most forecasters, including ourselves, think that you will still see some growth. The central banks are quite optimistic. If you look at the forecast from the Fed or the Bank of England, Fed's looking for 4% growth. That's Q4 over Q4 in 2022. And the Bank of England looking for 2.9%. Obviously, both those numbers are well ahead of trend growth in the two countries, which is probably 2% at best. We tend to think that the Fed and the Bank of England may be a bit higher on this, mainly because of the inflation headwind, which I think could slow things down. But I still think you will see growth continuing this year. I mentioned those strong asset prices, and this is just, I think, quite a good visual to show. So you've got the S&P Case-Shiller House Price Index for the US. House prices are up 28% in the last 2 years in the US. And if you look back to 2010, for example, so 2 years into the last recovery, house prices were still very depressed. There wasn't much in the way of transactions. There wasn't much in the way of house building. There wasn't much borrowing against housing. A lot of people were underwater. Very different conditions now. People are able to borrow. House building is moving up, very strong. And obviously the stock market, it took about 3 or 4 years for stocks to get back to where they were in the US after the 2009 crisis. This time already up some 40% from pre-COVID times. Excuse me. So very, very different situation in terms of asset prices. We're also seeing a much more confident labor force, certainly in the US, but I think to some extent elsewhere. And this chart shows the so-called quit rate. So this is people leaving their existing job, usually because they're confident of getting a new job. And again, we're up at a high there, about 3 million a month are quitting. Compare that with, again, 2010, 2011, when it was half that level. It went down during the recession and took a long, long time to come back up again, not really till 2017. And this time we're way ahead of that. So obviously there's lots of jobs out there. People are very confident. And when they're confident like that, usually they're willing to spend as well. I mentioned those savings that are accumulated, and this is a measure of household deposits in the US as a percent of annual household spending. So it's up close to 25% now. Pre-crisis, it was more like 10%. So again, there's all that money in bank accounts that people could spend. Now, to the extent to which they will is still very uncertain, because we know a lot of that is owned by the top 10% of the population, and indeed the top 1 or 2%. And maybe they're not going to rush out and spend so quickly. On the other hand, I suspect that some of it will be spent, especially if the COVID restrictions and the sort of COVID caution that we're still seeing fades during the year. I want to turn to inflation, though, because that's probably the critical issue that people are concerned about for its implications for growth, as I already mentioned, but also for monetary policy and whether we will see a much faster rate of tightening than is currently in the markets. And this chart is really just trying to show that service inflation, which is the blue line, is up as well as goods inflation. So it's not just the supply chain issues, it's also its service prices are moving up as well. So it's pretty wide ranging. And we see the same in the UK. This is the core and headline figures for the UK. So again, very strong consumer price inflation. You'll see the same in Europe. I don't think I've got that chart, but it's a similar story. Going back to the US for a moment, and there's obviously a lot of attempts to try to see whether this thing is transitory or how long-lived it might be. So we've got the core personal consumer expenditure deflator here, which is the one that the Fed watches. That's the green one. Obviously very high. They're aiming at 2%, and it's nearly 5%. And then I'm also showing what's called the Dallas Fed trimmed mean personal consumer expenditure deflator, which they essentially take off the items that have risen the most and also the items that have fallen the most in price. They actually exclude about 50% to do that. So it's maybe the middle 50% that they're looking at. And that's moved up as well. And typically that tends to show the direction you're going in. So again, it looks like inflation is moving up still. However, some of it clearly is transitory. And the chairman of the Federal Reserve Board recently said he wasn't going to use the word transitory anymore. But the reality is that some things there will pass. If you look at the yellow line, for example, used car prices up about 40%. In fact, more than 40% from where they came from. But if you look historically, they were pretty much flat. At some point, they're going to go down a bit, perhaps all the way back down to where they started eventually, although that might take time. But they will go down, and that big rise in inflation, that accounted for about 0.6% of inflation over the last year, for example, in the US. When prices, even if they stabilize, but especially if they go down, that will become a negative. And there's a similar story for new cars. And then if you look at the orange line, which is apparel, so it's clothing and footwear, it fell in 2020 and it's come back up more or less to where it was. It'll probably go sideways from here. So again, that's a transitory element that will drop out. One that isn't transitory is the rather steady blue line there, dark blue, shelter component. And that's been rising it's rising about 3.8% a year. So that's rents essentially. And it's quite a big part of the indices. And is actually, if anything, going to accelerate. So that's going to tend to hold the inflation numbers up as we go forward. But despite all the high inflation figures we're seeing in the markets, investors are not showing expectations for high inflation. This is the 5-year break-even expectations, and you can see it's only just over 2% still. So the markets are saying that inflation is not going to be a problem, that it is transitory, that even the modest rises in interest rates the Fed is going to do is going to be enough. We're not sure about that, and I'll talk a bit more about that. We're more concerned that actually this time inflation is going to be a bigger problem than it has been for, well, really for 25 to 30 years now. So to sort of summarize our view in terms of the outlook, we see growth slowing but continuing. We think inflation will fall back because of those transitory elements, but, and this is the bottom line, I guess, for this year, I think the danger is that it falls back to 3% rather than 2%. And then that could become a base for higher inflation in future years, especially if unemployment keeps on coming down. In the US now, unemployment rate is 3.9%. It was 3.5 just before the crisis. It will probably pass through that 3.5% level this year. So then we'll be in really low territory for unemployment. And that could tend to push wages higher. And that's going to be a key thing to watch. We do think that the central banks will stop and even reverse the quantitative easing. It's already happened in the UK. It's already slowed in Japan. It's slowing in the US. The US will probably start reversing it quite early this year. And we'll see further rises in rates in the UK and the start of rate rises in the US, most likely as early as March. Just a reminder on the QE, big rises obviously in central bank holdings during the COVID period. Japan there uses the left-hand side scale, so you can see it's about twice the Eurozone, 3 times the US. But big increases, those are starting to tail off, and we'll probably see that come down somewhat over time. Looking at interest rates, this is just a reminder of where we've come from over the last 20 years. So the economic cycle in the early 2000s was what we used to consider normal. You started with low rates after the recession, and they went up to sort of 4, 5, 6% by 2007. It came down, and then in the last cycle, most central banks were unable to get rates up very much at all. The US did get them up to 2.5, 2.75%, but rates were coming down in the US even before COVID. So there wasn't any real stickiness to those higher rates. And the other countries, we didn't see much of a rise in rates, just a little bit. So this time, I think we will see rates going higher. And our expectations actually is that they will stick this time. Right now, real interest rates in the US are near historic lows. This is just looking at the Fed funds rate minus the core CPI. And we haven't seen levels like this since the 1970s, when you also obviously had spikes in inflation. If I looked at the real bond yield on tips or on, tips is probably the best thing. It's the real yield has become slightly less negative in the last couple of weeks, but it's still pretty negative. So real rates like this is kind of the investing environment we're in. If you put money into cash, you're being eroded massively. If you put money into inflation-linked bonds, you'll get that inflation rate, but you have to accept that you're going to be losing out on the coupon all the time. So difficult environment when real rates are like this. I'm going to show a few charts about what's happened historically when we see tightening periods. So all these charts, the shaded area is when the Fed is tightening, or I'll show the Bank of England in a moment. That's the periods where interest rates are rising. And then the solid line, the red line here, is the US 10-year yield. And if you look back historically, it's a pretty clear pattern, actually. But the 10-year yield starts to rise at or before the tightening period, before, doubtless because the market's anticipating the Fed, or even the Fed has warned that it will raise rates. But then quite often the 10-year yield peaks before the end of the tightening period. So it seems likely to us that yields will rise again during the current tightening period. Here's the UK picture. Not quite as clear cut, I would say. There was definitely an exception in the late 90s when the bond yield came down despite a tightening period. But it was pretty high at that time, and that was just after the Bank of England got its operational independence, which may have been a factor. But generally, you can see there tends to be a lift to 10-year yields during tightening periods. About stocks, well, the picture is again that is fairly clear cut, I think, for the US, which is that stocks tend to move sideways or up even when the Fed is tightening. And in a way, that's not too surprising because usually the Fed is tightening when the economy is doing well. So why would stocks fall in that environment? If the economy is doing well, profits are tending to rise. Um, Again, it may be that stocks will fall at or after the period of Fed tightening. Often Fed tightening leads to a recession. So again, that's not too surprising. But during Fed tightening, and remember, we haven't quite started yet, there's no particular reason why stocks should do badly based on the historical performance. But it's quite interesting if you look at what's driving the stock market, because during periods of Fed tightening, it doesn't seem to be the earnings multiple. This is the price earnings ratio. I'm using here the CAPE ratio, originally from Robert Shiller. You can see that the CAPE ratio tends to be stable or even down, usually stable, I would say. Look back at 1994, 2000, early 2000s, and then slightly different in the last cycle, where we did see some multiple expansion even while the Fed was tightening. But remember, it didn't raise rates very much in 2015 or 2016, 2017. And here's the UK. Again, stocks tend to rise during tightening periods, not always, but usually. And they often fall afterwards, but not during the tightening period. Again, though, you see the multiple tending to be weak, stable or weak during periods of Bank of England tightening. So again, it's what has to drive stocks during tightening periods is profits, not so much the multiples. And that makes sense because as interest rates go up, you would expect that therefore the discount rate of future profits is higher. So you wouldn't really expect the multiple to expand. But if there's an optimistic profit outlook, then the stock market can still rise. So to conclude on this section, what happens to markets during central bank tightening? We are expecting the Fed to raise rates 3 or 4 times this year, more likely 4. In fact, the market's priced in 3 at the moment, and continue to raise rates in 2023. And in the UK, we're expecting 2 to 3 rate rises. The market's expecting 3. We think it might be 2. And one reason for that is the UK has a tighter fiscal policy. We have the tax rises coming through. So we think that may be enough to keep the Bank of England a bit more cautious. Plus, of course, when the UK raises rates, it does impact on consumers much more quickly than it does in the US. It's true that most mortgages now are on fixed rates, but many of them are on 2 and 3 year fixes, which will soon run off. And there's still a significant part of mortgages which are on floating rates. So I think that will keep the Bank of England a little bit more cautious. There just won't be as much growth, and interest rates will impact more quickly. The ECB, I think, will be on hold as far as rates go. They'll slow down the QE, but they won't raise rates. The reason for that is that although they've got high inflation at the moment, it will come back down. It'll probably come back down near 2%. So that's where they want it to be. So there's no particular reason to raise rates in a hurry. We think that US bond yields will probably rise in this environment, and we're expecting to get up to 2.5 to 3% this year. And that UK and Europe yields will come up as well, partly dragged up by the US, but also the local monetary tightening we're going to be seeing. We're expecting stock markets, as in previous tightening periods, to be sideways to up, but typically volatile. We're at a stage of the cycle where stock markets tend to be more volatile, as we've seen a little bit of that already recently. But nevertheless, in this environment of continuing economic growth and cautious, steady tightening, there's no particular reason to think that stocks should do badly. I should qualify that. There's one reason, in the US at least, which is the valuations, and I'll show you a chart on that in just a moment. We do expect to see that rotation away from growth stocks towards value stocks. It started a bit early last year and then kind of reversed, and it's been going on a little bit in recent weeks. We think that will continue as interest rates rise. What are the risks to our view? Well, first of all, COVID. Obviously, the Omicron variant is running through the world rapidly at the moment. It's very infectious, but seems less deadly, certainly with people vaccinated. We're assuming that COVID will slowly fade this year, that there'll be more vaccine coverage globally, that people in the West will probably get third and fourth shots. It'll become more endemic, will behave more normally. I guess it'll fade gradually rather than rapidly. There is a risk, though, and this is where the risk bit comes in, that we get another variant which is more deadly. I think that would be the main problem that we could face if a new variant comes along that's more deadly. Another possibility, another risk is that growth stalls. I gave all those headwinds, in particular the rise in inflation. Maybe the net comes out the other way. Maybe people don't spend all those savings. Maybe we do see the markets fall off, and that affects sentiment. Maybe inflation is just so high that it subtracts from wages sufficiently, people can't spend as much. So a slowdown in growth, and perhaps linked to a market crash. I've said already that it's unusual for stocks to do badly in the absence of a recession. Probably the big exception was 1987, when in the middle of an economic upswing, without really much of an inflation problem, stocks crashed. Now, the Fed was raising rates at the time, had already raised them quite a bit. The market went up rapidly that year, just as it's gone up rapidly over the last year, and then we saw a big correction. It lasted a couple of years, and then we were back to pre the crash. So that there is a risk of that, and I don't think. Well, there's plenty of people who wouldn't be too surprised to see that. I guess we wouldn't be too surprised to see that either. Another risk is China. I've talked about China on previous webinars, and I haven't got really time to go through it in detail. But the story here, as you probably know, is they've got too much debt, they've got a large fiscal deficit, they've got overcapacity, they've got the property issues with Evergrande. So basically, too much property has been built. There's too much risk in the house building sector. They're trying to scale that back. The danger is that they overdo it and the economy slows too much, and secondarily, that could lead to a financial crisis. Most people think, and we tend to agree, that they will manage this thing. Most of the debt is owned by state companies to state banks. I mean, Evergrande's a bit of an exception there, but that's generally true. They can take over things, they can intervene. So we tend to think that it will not end in a crisis. We do think, though, that China will slow down further. They'll probably be quoting growth of 5% going forward officially. We think it'll probably be lower than that in reality. So China slow down, but without a financial crisis. But I've said to people before, if we find that in a year's time or a couple of years' time we've forgotten about COVID and we're all talking about the China crisis, the next crisis, if you like, after the GFC and the Euro crisis and the COVID crisis, if we're all talking about the China crisis in a year or two, I don't think we'll be that surprised, given all the imbalances that China still has. And then there's geopolitical issues. Still got Ukraine, which could bring issues. We wouldn't expect a military involvement by the West, but you could see serious sanctions. You could see interruptions to gas supplies from Russia. So there's potential for some volatility there. And then US and China obviously are very much rivals these days. Potential for confrontation there it's always there. And just to remind you about those valuations, this is the cyclically adjusted price earnings ratios for the various markets. US is close to where it was at the peak in 1999, 2000, pretty high levels. Now, the US has some fantastic growth companies. The big 5 or 10 stocks that are dominating the index, most of them have very strong profit growth. So there is a reason, I think, why the market is strong. Maybe it shouldn't be this strong. You can certainly argue that. If you look at the EU and the UK, not nearly as overvalued, and certainly, although the EU is now at higher level than it's been for most of the last 20 years. It's still well below where it was in 2000. And the UK market we actually see is still rather inexpensive. Again, there may be good reasons for that, like Brexit, for example, and also the makeup of the index. But nevertheless, we are tending to see that as certainly not overvalued. And with that, I'm going to pass on to Jerry to talk about things a little bit more from the technical side. So if I can pass over to you, Jerry.
Thanks, John. I'm not going to tie up too much of the time here on this talk, but one of my jobs is to always look for risks and speak with John and James and try to come up with where are we now in terms of strategy. So what makes this difficult is that we've had such a storming rally in the U.S. stock market, and this is the chart of the S&P 500. It's a monthly chart, I believe, and it's semi-log. So in other words, it's supposed to be percentage gains on the axis to try to give you some sort of balance of percentage gains over time rather than just a straight line up. It actually doesn't work. It still looks like a straight line up to some degree. And it's one of those things where you have to look at this and realize, one, we've come a long way. And two, anybody who thinks the market is frothy has a lot of sort of reasons to think that on this chart, because we've really stormed really higher on the back of, who knows, we can talk about low interest rates, quantitative easing, lots of money around, whatever argument you want to look at. This market is really high, and it's really far away from that support line drawn from the lows of 2009 and the 2020 crash. So what does that mean from a technical point of view? From a technical point of view, basically, we're nervous, we're watching it, we realize it's an uptrend, and we realize that in theory, we could drop 10, 15, 20% without actually breaking the uptrend. And that's one of those things where you kind of scratch your head and you think, okay, do I try to time this? So I look for strategic areas of, getting some sort of protection on, that sort of stuff. And that's what's, when we say our outlook for 2022, we always say, yeah, it's probably going to do all right, but it's going to be very volatile. And that's the sort of thing we're going to be looking out for this year. John, if you could move forward. Thank you. And if you thought the S&P was up a lot, this is the NASDAQ 100, which, as we all know, is a tech-heavy index of the U.S. market. And here I drew a bullish channel, and you can see that we've actually climbed outside of that bullish channel. So not only are we really bullish in terms of the trend, we're uber bullish, if you want to put it that way, and we're actually exceeding the top of the trend channel that we had before. For non-chartists, this doesn't mean much, but for chartists, they go, wow, that's really strong. And obviously, you're probably overbought. And yeah, you should be looking for maybe some corrections, but the trend is by no means over. There's nothing on here to say the trend is over. All it does is say exactly what John's been saying is, yes, it's a bit overdone on the upside. You could argue valuations are overcooked, but there's nothing here to say that it's going to collapse at any moment in time. Next chart, please, John. And here for the FTSE 100 fans, which we are one of them, we're thinking it's finally breaking higher. We've had 20 years of trading a range, and we think you could actually be getting set up where we try to make new all-time highs again. So this is one that we're watching closely. As you all know, the FTSE 100 is a really strange index in terms of, the makeup of the index isn't all domestically oriented. We have oils, we have miners, we have pharma, we have banks, and the biggest banks are all Asia focused. So we watch it closely, and we're hoping for some decent upside here. And the next chart, please, John. And we're looking at the Japanese market because they have a lot of positive things going on there at the moment. And in our view, they continue to do well. So we've had the breakout. That's the red line. And we think as long as we hold above this, which we expect we will see grinding gains towards the 2800 level in the topics. And the next chart, please, John. Cable. Why do we look at cable? Well, everybody in the UK sort of looks at this one way or another when you're making valuations on companies that have dollar earnings, or if you're looking at any sort of international exposure. Obviously, Brexit gave us the move below 150, 1.5 and a definitive level. And chartists saw the targets between 115 and 110. Those are mostly met. And if you look at extreme long-term stuff, you could be looking for parity or the 105 low from 1985. Or you could be arguing for 0.75. We don't argue that very often. At least we don't argue that externally. We have internal arguments all the time. But the red line there at 150 sort of marks the point where John and I agree that cable could actually come back to 150, and that would be sort of fair value, if you will, to some extent. remember this sterling traded above 2 for a while, not so long ago, back into 2007, 2008. And it was one of those things where abandoning that was reasonable, getting down to 150 was reasonable, and getting way below 150, everybody kind of thinks maybe sterling's a bit undervalued, which leaves us for a very strange outlook for this year, which is probably meandering around, hopefully at some stage, maybe getting back to the 144, 145 area, and maybe taking a look at 1.5, the 150 level. The reasons for that, though, would probably be more dollar-based, I would say, John, than sterling optimism at the moment anyway. And there is still a considerable risk that we do nothing above 145 and we just drift back down to 126 and remain in this very flat range. And the final chart for me, please, John. This is looking at the US 10-year yield and the coupon curve. The coupon curve is the bottom spread chart, and that's a spread between the US 10-year yield and the US 2-year yield. We're expecting the 10-year yield to go up. And to be fair, I said the same thing last year, where I said this is going to go up. But then we were talking about maybe reaching 1.7, trying to break above 2 for 2.5. We got 1.7. We didn't get 2. We didn't get 2.5. So this time around, I'm just going to say, I think we're going to go to 2, and then we're going to go to 2.5 and higher. Technically, we should actually see a swing towards 2.8, maybe 3%. But that's probably going to be later in the year or 2023. Ideally, this will lift the coupon curve, and that'll give you a steepening curve, which should be good for banks and should be good for other financial markets or financial companies in the financial sector. There is a risk that the coupon curve does actually flatten instead of steepens, though, and that's something we'll be watching throughout the year. Thank you for attending. John, thank you again.
Okay, thanks, everybody.